1.2 million in business profit, but you paid less than $40,000 in taxes. I'm gonna show you exactly how a husband and wife came to me and they netted 1.2 million through their LLC and they paid less than $40,000 in combined federal and state taxes. If you guys wanna understand this game, first off, like, comment, subscribe, because I'm already laying down the best tax advice on the internet and I show up every single week for you. But in this video, I'm gonna give you a full example of 9 ways in which I implemented strategies for my client and I was able to get their tax bill under $40,000. And these are all strategies that are 100% legal in the United States tax code. And if you're a United States resident, you could be leveraging these strategies too. Without further ado, let's dive in. All right, guys, so first things first is I had a husband and wife. Both of these individuals were Arizona residents. Arizona has their own state taxes, so I knew it was gonna be important for me to leverage some strategies to reduce their overall income. The husband and wife were working as physicians. The husband was the main breadwinner. The wife chose to work inside the husband's business. Their business was a PLLC. Anytime you're a chiropractor, doctor, or physician, sometimes you'll have a professional LLC established for yourself. This professional LLC is also where you'll get your licenses and accreditations underneath for your entity. So the first strategy that I leveraged was transitioning the PLLC over to an S-corporation. Once I transitioned the LLC to an S-corporation, I eliminated all of the business's profits, which was around 1.2 million, from being subject to 15.3% self-employment tax. What ended up happening was the business owner, who's the husband, he had to take a reasonable compensation or payroll from his S-corporation. I had him take $366,000 in payroll from his S-corporation after we've transitioned his PLLC over to an S-corp. So that was the very first thing that we did. Transition from an LLC over to an S-corporation. Number 2 is I made the decision not to place his wife on payroll. You'll come to learn why I chose not to place his wife on payroll later on during this video. But the main reason why I did not want to place the wife on payroll is I didn't want to qualify us from being able to use real estate depreciation to offset the S-corporation's working income. So step number 3 was, after the husband took payroll, I met with our financial advisor and I decided to open up a cash balance plan instead of just a solo 401k. The reason why I decided to open up a cash balance plan instead of just opening up a 401k is because the 401k has limitations of around 66,000, whereas the cash balance plan is based on your age. And because the husband was around 46 years of age, I was able to put up to $240,000 into his cash balance plan in that year for a tax deduction. This reduced the overall adjusted gross income on the tax return by $240,000, which is a lot greater than the $66,000 that you get with a SEP or a solo 401k. Now, step number 4, and probably one of the most important steps, was qualifying his wife to be a real estate professional. Because his wife was at home taking care of the children and the children were getting a little bit older in age, it made sense for the wife to focus primarily on helping the husband grow the business, but not playing an active role inside of the practice. So what we decided to do was we decided to qualify her as a real estate professional. Because the husband and wife had 2 investment properties that they already owned, plus they were open to buying more rental real estate, we went through an acquisition phase of acquiring a $1.2 million single family residence in Arizona, as well as utilizing the other 2 investment properties that they already had. Because the wife and the husband managed these properties themselves, we knew that the long-term rental strategy that they were playing into would allow for us to qualify the wife as a real estate professional. We were able to show that the wife was spending 750 hours in the year managing the investment portfolio, and she was spending more time than any of the other contractors or repair people that would come by the property periodically to make repairs or improvements. Because we were able to qualify the wife as a real estate professional, we were able to move into strategy number 5, cost segregation study. Cost segregation study happens to be one of my favorite write-offs, and to be honest, it's probably one of the most powerful write-offs in the entire US tax code. With the cost segregation study, we performed 3 separate studies on 3 separate properties. They acquired 1 property in 2023 and had 2 other properties that were both acquired in 2017 and in 2018. By performing cost segregation studies on all 3 of these properties, we generated around $600,000 in year 1 depreciation. And that's because the property that they initially bought in Arizona in the year of 2023 had 90% building value value to only 10% land value. That means that we were getting a lot of depreciation on that property. And the other two properties that they had, they never ran depreciation on these properties on their tax returns. So not only were they missing out on these deductions, they were also missing out on the ability to use the depreciation to offset their other forms of income, which would be the income that was coming over from the husband's S-corporation. Performing these three cost segs gave us a $600,000 deduction on top of the $240,000 cash balance plan, retirement plan that was set up for the husband. Now we started to get some big write-offs. The next thing that we wanted to do is we wanted to show the IRS that the wife was managing the rental portfolio. So we established a rental management company. This rental management company was owned by both the wife and the husband, making it a 1065 tax return or a partnership LLC. By having a partnership LLC, I'm keeping all of the management company income outside of their individual tax returns, which reduces their audit risk. But with the management company LLC, we had them pay a fee from their holding company LLC that was holding on to the property that they purchased, as well as the two other holding company LLCs that they had with the existing properties that they already were managing. And all three of these LLCs paid a management fee to the brand new LLC that was created in 2023 that carried the husband and wife underneath it. But rather than just moving money over into the management company and having to pay taxes on the money that's sitting inside the management company, we decided to place their three children on payroll, and we were able to give them each a $13,850 salary from the management company LLC. Now, you might be wondering, why did I choose to place the children on payroll inside of a management company that's managing the investment properties? Why not place the children on payroll inside of the S-corporation that's running the practice? Well, the reason why is when you place children underneath the age of 18 on payroll through an S-corporation, you will have to pay payroll taxes for those children. So rather than trying to pay payroll taxes for placing the children on payroll, we decided it made more sense to set up a rental management LLC that was owned by the wife and by the husband, and the rental management company employed their three children to help out with the real estate portfolio. Since mom was already going to and from the properties on a week in and week out basis, it was very easy for her to have her children accompany her and manage those properties together as a family. By placing the children underneath the rental management company, we were able to receive a tax deduction equal to $13,850 per each child. And this started to increase the amount of write-offs that we were taking on the returns. But that wasn't it. Because the husband was running a practice and the wife was managing the real estate portfolio, the husband had his own vehicle that he was utilizing for business, and the wife had her own vehicle that she was utilizing for business. Inside of the husband S-corporation, we purchased a Range Rover that cost $185,000. With code section 179 plus code section 168K, we were able to write off 80% of that vehicle in the year of 2023. This created another deduction on the tax return that was able to offset the income that flowed over from the S-corporation. Now we were really seeing some substantial write-offs. We had over $600,000 of accelerated depreciation from a cost segregation study. We had over $240,000 from a cash balance plan. And now we're receiving another additional $150,000 deduction for writing off a Range Rover. But we were not done yet. Not only did we get to include the children on payroll, the Range Rover, and the cash balance plan as tax write-offs, the husband and wife also decided that it was time for them to be philanthropic. We decided to set up a private family foundation for them. We placed both the husband and wife underneath the private family foundation, and we made the children all board members. Because typically when you're doing things in the capacity of a foundation or being philanthropic, you're going to include your family. And part of the reason why you would establish a private family foundation is because you have other family members who you think it would be important for you to be philanthropic with, who could also be compensated for doing philanthropic activities. We chose to allocate $150,000 into the private family foundation for a tax deduction in the year of 2023. Not only did this money go into the foundation where the husband and wife have control over the assets, only 5% of the charitable assets that we placed inside of that foundation actually had to be dispersed out to another qualifying 501c3 or charity of their choice. This gave the husband and wife full autonomy over how they wish to disperse their charitable assets and also reduce their tax tax bill at the exact same time. So now that we've already claimed $600,000 of depreciation off of doing 3 cost segregation studies, we decided to take the cash balance plan for almost $240,000. We wrote off a Range Rover for about $150,000 with Code Section 179 and Code Section 168K. We moved over money for the management fee, then paid out the children, 3 children, through the management company. You would think that we're almost done. Well, no, we also had the private family foundation where we allocated $150,000. And last but not least, by leveraging Code Section 280A, we were also able to incorporate the Augusta rule right before the end of the year. And he was able to hold board meetings between him, his wife, and his family inside of their house for 14 days prior to the end of the year, in combination with other events and household meetings that he needed to have for his business. And we were able to write off $28,000, $2,000 per day in rent because of the size of his primary residence in Arizona. When you combine these strategies together, we were able to take his adjusted gross income all the way back to down to about $145,000, and his overall tax bill was roughly $36,000. This is the power of leveraging cost segregation studies, shifting income to your children who have lower tax brackets than you, and making sure that you don't overcompensate them, utilizing management companies, especially if you're managing your own investment properties, qualifying your wife as a real estate professional, especially if she's able or he's able to show the IRS that they're spending 750 hours and more than any other person in rental real estate, the ability to be philanthropic and knowing how to use a philanthropic entity structure such as a private family foundation, and most importantly, Code Section 179, the ability to accelerate depreciation in the form of a cost seg and in the form of writing off a vehicle. This is one of the many ways in which I'm able to help business owners, real estate investors, and taxpayers on a yearly basis with the tax code by also making sure that they're following the rules and taking advantage of what's at their disposal. Nothing about what you heard here was easy. This required them to be active in real estate. It required the wife to have a management company. We needed to make payments. We needed to place the children on payroll. We needed to have our own philanthropic entity. But being able to say that you saved over $400,000 in taxes, plus you own a new investment property and your children are involved in your business, yeah, that's something that I can get myself behind. Matter of fact, that's something I can definitely get behind. And many of my clients would say the exact same thing. Karlton, I want my children working for me. I want us building wealth. I want to own real estate, and I want to make sure that I'm not overpaying Uncle Sam. And if these are things that you care about, you'll take it upon yourself to sign up for a consultation. You'll take it upon yourself to find yourself the right tax strategist. My name is Karlton Dennis. I hope you enjoyed today's video and you learned something new. But if you would like to learn more about the strategies that we teach on this channel, you can feel free to get in touch with my team by clicking on the link below into today's description. You will also find our ebook called The Short-Term Rental Rule. In this ebook, I teach you the most advanced tax strategies used by the top 1% to reduce their taxes on a year in and year out basis. So I hope you'll check that out as well. You know what to do. Like, comment, subscribe, and I'll see you on the next video. Thank you so much.